NVIDIA is all that anyone seems to be able to talk about these days. Look at all the growth. Look at all the revenue. Look at all the earnings. Will this amazing story ever stop? Yes, of course it will. And likely slaughter a lot of investors without warning. To be fair, and let investors have the full picture, it would be helpful to lay out the bull and bear cases for NVIDIA and see how the investment stacks up on a risk versus return. On the bull side of things, you can plainly see that NVIDIA is a market leader in the emerging market of AI chips. No one knows how big the market could be, but if you listen to some analysts, it is a multi-trillion-dollar opportunity. It has incredibly strong margins, and as mentioned previously, they have been growing revenue at an insane rate. Year-over-year revenue growth now stands at over 265%. Bottom line profit margins are over 50%. These are numbers that Pablo Escobar would be proud of. You would be insane to think that such a company wouldn't also be very, very valuable. And you would be right. But how valuable is the question? On the bear side of the coin, the issue is simply valuation. The company has a price-to-sales ratio over 30 and a price-to-earnings of nearly 60. These are numbers that are usually reserved for small-cap businesses that are growing quickly and have years of potential ahead of them, not a $1.7 trillion market behemoth. The revenue growth has also been slowing quarter over quarter, from an initial jump of $6 billion to now only forecasting a $2 billion increase next quarter. The growth is definitely slowing. It is hard to constantly find billions and billions of additional sales every quarter for hardware. That is why chip makers are a cyclical business of booms and busts. So if you are a bull, you are likely targeting at least a 15% gain over the next year to account for the risk. That would bring the valuation to just about $2 trillion. In order for that to happen, you need several things to go right. Number one, you need revenue growth to continue at an annualized rate well over 20%, despite the fact that quarter-over-quarter increases are falling. Number two, you need margins to continue to run at over 50%, well above the long-term trend of 30 to 40%. Number four, you need the hype train to continue to maintain the very high valuation metrics currently in plan. Number five, you better pray they don't miss any estimates on top line, bottom line, or even issue cautious guidance. It has to be all hype, all the time. Bears have it a lot easier. If any of the above don't work, then the house of cards falls over and you make bank. But there is a very large but. Valuations can stay irrational for a lot longer than you think. As a bear, you are standing in front of a runaway train full of fools and trying to get them to stop by convincing them they are fools. Likely you are going to be run over more than once. So, if you want to be a bear, you will need patience, timing, and a high pain tolerance. Otherwise, just be like Warren. Take your cash, grab your popcorn, sit on the sidelines and wait for the inevitable train wreck, and then you can pick up the pieces for pennies. This is Foxhole Financial wishing you a prosperous risk-adjusted return.